Hey guys, how's it going? My name is hamishwhodder, and today we are back with episode 6, I believe, of the YouTube stock portfolio, which is the series where we're going through and analyzing a bunch of companies and adding them to a public portfolio that I'm going to be sharing with you over the next few months and years and however long we run this for. And in this episode, I thought we'd start off by having a look at how the portfolio has been going over the past month, um, and just sort of talk about some of the moves and some of the news topics that have some of the news highlights that have happened in relation to the stocks that we currently hold in the portfolio, and just give a little bit of an update. Even though it's important to note that short-term movements in the stock price don't really mean anything to me, and they really shouldn't mean anything to you as a long-term investor. But it is interesting to have a look at how it is moving over time. So I thought we'd start off by having a look at that. And then, of course, we're going to jump in and continue our search and continue to analyze some of these stocks in our list. We've got stamps.com, Skechers, and we're also going to have a look at Wynn Resorts to finish off our list. And then we're going to dive deeper into the stocks that remain on our short list. And at the moment, there's 4 stocks that have remained. We've got Ford Motors, Apple, Amazon, and Google. So we'll see if any of Stamps, Skechers, or Wynn, if any of those can stick around and make it to the next stage where we further analyze these businesses and put a value on how much they're worth and what price we would be willing to pay. All right, so here are the current positions that we have in our portfolio. Of course, we have Facebook, we have the S&P 500 index, which tracks all of the top 500 companies in the US, and then we have Thor Industries. And up until last week, actually, this portfolio was up quite a bit, but there's been some news and some earnings that have come out that have significantly hurt the performance of the portfolio since then, unfortunately. So first up, in 25% of the portfolio, we have Facebook. And Facebook, since we purchased it, we bought them at $180 per share, and the last price has been $169. So we're actually down about 6.45%, which is quite a lot. And I kind of did expect Facebook to continue to fall. I really wasn't sure what Facebook would do over the short term, but I do think that it is a stock that's priced at least fairly valued, or maybe even a little bit undervalued, based on its growth prospects. And I think it's just faced a bunch of really, really bad sort of press recently, and that's just pushed the price down. And especially with stocks that are covered so much. Facebook is one of the most covered stocks. There's tons of news articles. CNBC, Bloomberg, they talk about it almost every single day. It's one of those stocks that are just always in the news. So whenever there's a shift in the perception or the way people think about a particular stock, such as Facebook, that is so widely represented in press coverage, it does get hit quite significantly. And as you guys would know, since their earnings report, Zuckerberg did say that there was going to be some increased costs and some slower growth in terms of earnings due to things like increased security and having to hire more staff in order to cover that security. And they're actually going to be bringing in less revenue because they're limiting the amount of the number of pages on Facebook and that sort of thing that are allowed to advertise, so that they can limit that fake news sort of stuff and make sure that only legitimate ads are being run on their platform. So whenever a bunch of news like that comes out, it's all over the press. It's on CNBC, it's on Bloomberg, and a bunch of newspapers write about it 100 times. And the sentiment of the stock shifts quite quickly. And that's kind of what has happened with Facebook. And we're kind of just waiting for a shift in the sentiment to go back to being positive. Maybe it'll be the next earnings report where Zuckerberg says, you know what, the security costs weren't as impactful as we thought, and we're still going to be able to grow at 30+%. Or maybe he won't say that and it'll continue to be bad sentiment. We don't really know, but basically, if this company can grow at double digits over the next 5 or 10 years, we will see a very nice profit on this stock over the long term. So I'm very confident in Facebook stock. Then we've got the S&P 500, which has continued to go up as the market continues to expand, which is really great for us because 50% of our portfolio is in this index fund. And this is kind of the structure that I recommend you start out as a beginner, because as you can see, our stocks haven't been performing that well, our individual picks, at least in the short term. So it's good to know that we've got a broad market base that is tracking the whole market and giving us that average return of about 8 to 12% per year, so that if our individual picks are poor, it doesn't really matter because we've got that strong base of a wide diversification. And the S&P 500, since we purchased it at $283 per share, is this SPY index. That's the ticker symbol for it, SPY. It is now at just over 200, or almost 291. So we've actually made almost 3% on this stock in the last couple months, which is really great. That's a great return to have in just a couple months, especially if you're looking at a long-term perspective. So it is good that that is keeping our portfolio from sinking too far while our individual picks perform poorly. And then lastly, of course, the last 25% of our portfolio is in Thor Industries, which is my biggest position in my personal portfolio as well. And this stock was actually starting to move back up. We bought it at $95 per share. It's now at 85, which is a 10% drop, which is quite dramatic. However, it was moving back up to $105 per share because they actually made a massive acquisition in the past week. They have acquired, or they've kind of merged. It's an acquisition, but it's basically a merger because the company is so big. It's almost as big as Thor Industries itself. The company is Heimer, and it's also a caravan manufacturer, of course, as Thor Industries is, and it is the biggest caravan manufacturer in Europe. So now we've got the biggest manufacturer of caravans in the United States merging or acquiring the biggest one in Europe, or this German company. And that is a huge acquisition. I think it's going to add about 40 to 50% in terms of cash flow and earnings power to Thor Industries. So it's really, really increasing the value of Thor Industries. And that actually sent the stock up about 12% in about a week, but even in a couple of days since that news came out. However, the next 2 days after that, their full year earnings report came out, and it was quite poor, or it was very weak. And the sentiment is that this stock is going to continue to face headwinds in terms of production costs, labor costs, commodity prices, and also these tariffs on aluminium and steel, which are significantly impacting, or not significantly, but they are having impacts on the cost to make these caravans. And the Wall Street didn't like the results. It sent the stock down about 13% in a day, which is a huge drop. And it was quite disappointing to see, but my long-term outlook for Thor remains the same. And I just want to talk about that a little bit. So I've gone ahead and updated my spreadsheet for Thor to add the 2018 financial year into their data. And as you can see under the 1 year, we can see what results they had for the 2018 year. So they've done sales growth of 15% year over year, earnings per share growth of almost 15% year over year, equity growth of 23%, which is amazing. That's really great. And free cash flow growth was a little bit slowed, but that was primarily due to them paying off that last bit of debt, which they now have no debt whatsoever at their credit facility, which is amazing. Although they will now be taking on more debt from this recent acquisition. So they cleared out their past debt, and they're ready to take on new debt from this acquisition, and they'll be managing that effectively as they have managed all of their debt in the past. So we can come over and have a look at the value matrix, and I've inputted the latest earnings per share data, and I've also put in the price that we paid for the stock, and we can decide if we want to add some more as it continues to fall, because what was it at? It was at $85 per share, I believe. Yeah, so it's about $86 per share at the current time. So maybe if it goes to about 80, we'll buy some more. Maybe we'll buy some more soon. I'm not really sure. Let me know what you want me to do with Thor down in the comments below. But I'm thinking about adding some more, maybe if it drops maybe another 5 or 10%. But I've entered in the new data to see what return we can expect to get over the next 10 years. And as you can see, the growth rates that I've got here are very conservative. We've got a 2%. That would be a very, very conservative outcome for Thor. If you have a look, their earnings per share over a 23-year period has done 7.5% growth, which is incredible. So to say that they're only going to do 2% over a 10-year period is pretty crazy. If you over the last 10 years, they've done 50% almost 50% growth per year. And this is a $1 billion company. That is huge growth. And you can see even 17 years, they've done 12.5%. They've never really dipped below 6% over a very, very long time. So I think that 2% as a conservative, worst case scenario, this company performs terribly. I think that is okay. And you can see I don't really have much upside. I mean, I could put a 40% in here because that is technically what they've produced over the past 10 years. Although that's a little bit unfair and a little bit unrealistic. I think these numbers between 8 and 12% are quite realistic for the next 10 years. And I think that I think Thor could vastly outperform this. But as a base, as a conservative investment, I think this is a good entry point and a good assumption to make when we're doing this. And if it outperforms that and we make 20, 30x on this stock, that's great. But I want to make sure that I am certain to get my 15% return, my 4x over a 10-year period. And I think that using an 8 to 12% rate is very fair. So if we want to get our 4x over the next 10 years and they do 10% growth, they need to have a PE ratio of between 16 and 20. So that's pretty fair. 11 to 22 has been the range of their PE ratio over the past 5 years, and pretty much historically they've bounced between a 10 and a 20 PE depending on what the climate's like in the market. For example, when everyone was really hyped about Thor earlier in the year, it had a PE at a max of about 22, I think. And then we had all those bad news come out about the tariffs and that sort of thing and the increased costs. And their PE is now at about 10, I think, or maybe it's even under that. I think it might be a 9. So you can see that between the very high optimism, it bounces up to about a 20, and then low optimism, it bounces to 11. But to be clear, if this company goes out and does a number of acquisitions and starts to grow really rapidly at 20, 25, 30% per year, as it has at some points in the past, we could see this company reach much higher PE ratios. It could get to a 30 or even a 40 PE ratio if people think that there's going to be very, very high growth coming out of this. So again, we're being very, very conservative with our PE ratios. So by looking at this value matrix, we can be pretty sure that we're going to be able to get about a 15% return. And I'll tell you why. Even if they do 8.6% and we sell them out at a PE of, say, 16, we'll still get 12% from the stock price going up. So that's from what we buy it at, 95, and then we're going to be selling it at $297 per share. And that will give us a 12.09% return. But remember, that's not the only way that we make money on a stock. We also make money when they pay out a dividend to us into our accounts. And Thor Industries at the moment is paying a 1.5% dividend, but they've been increasing that every single year. So if they continue to do that over the next 10 years, we can pretty comfortably assume that we're going to get about a 1 to 3% per year dividend over the next 10 years as it averages out. So we might get a 1.5 now, but if they increase that over the next few years, those later years might be a 4 or 5% dividend, and that'll average out to a 2 or 3% dividend, which will mean overall that we end up getting our 15% return. And I think it's very likely that we will be able to sell Thor Industries with a PE of about 22, maybe even higher, but definitely around that price. And I think that them doing 13% or 12.91% growth per year for the next 10 years is by no means unrealistic. I think it's a very conservative estimate of what they can do. And if that happens, we will make a 20% return plus dividends. So maybe a 22 or a 23% dividend, or even a 22 or 23% return overall, or maybe even higher. So that's just my thoughts on Thor Industries. I'm still very bullish on the long-term perspective. I think it's getting hurt because the next couple of years don't look that bright for Thor because of increased costs and the looming economic downturn, which will significantly impact the number of people who are buying caravans and that sort of thing, because people are going to be saving and trying to pay down their debts during a recession. But if you have a long-term perspective and you're looking out into the next economic cycle beyond what people on Wall Street are looking at, because they're just looking in the next couple quarters or the next couple years, if you look beyond that, you can see real value. And I think we'll be okay with Thor. So that's my thoughts on Thor and their earnings. And I think now we'll just jump in and continue to analyze some of those other stocks. All right, so sorry for that massive introduction, a massive conversation about those stocks, but I think some of you will find that interesting because a lot of you were asking me questions about Thor Industries, asking me if I was still bullish on it, if I was selling or anything like that. So I thought I'd just give you a chance to hear my thoughts on that and sort of just explain where I'm at with it. And I don't want this video to go on for too long, so hopefully we can get through these last three and give them a yellow or a green or just boot them from our list. And then next week we'll go through and further analyze these businesses, put a value on them and that sort of thing, and see what price we're willing to buy them at. And we'll go a little bit more in depth into the management because a lot of you guys don't really know what you're supposed to be doing when analyzing the integrity of a management team. So I'm going to go through the annual reports and show you what I look for and what are the important aspects. But we'll do that next week. For now, let's have a look at stamps.com. So stamps.com, they've had really strong revenue growth, which is great, over 18%, earnings per share growth of 32%, wow, and they've got a PE of 23. So this looks like it could be a very promising company. ROIC of 27%. That's amazing. So let's jump in and have a look at some of their numbers. So revenue growth, it's fine. That looks great. We'll probably put those numbers in. Earnings per share, again, looks very good. They have one negative number there, which is a little bit concerning. But their earnings, for the most part, are pretty straightforward or straight up. I mean, besides that big negative, they look like they're all pretty much one after the other. Each year is a new high, which is what I like to see. And you can see here that even on the negative day, we can go down and have a look at why it was negative to see if it's something that's concerning. So if we go from the top, we can see nothing concerning here in the revenue because it's just going up and up. Then we have a look at the gross profit. Again, it's still high. Come down here, we come down to operating profit. We can see that it's still high, so there's nothing there. Now here, you can see the big negative 56, and that's what's caused it to go negative. It's an other non-operating income. So that means it's some kind of one-off instance, one fee that isn't related to the operations of the business. Maybe it's a depreciation or maybe it's a markdown of their goodwill or some kind of intangible. So it could just be that the accountants that look at this business have decided that some of their intangible assets or even some of their tangible assets, real assets, they might have found that they're not worth as much as they were showing on the balance sheet. And that's got to be expensed down. So it could just be completely irrelevant to the performance of this company, which it looks like it probably is. It could just be an accounting technicality. So it's important to know, it really does help to know your accounting and know what these things mean. And it's really not that hard with Google to understand these things. If you don't know what other non-operating income is, just Google it, find out what it is. You can even Google, what does this mean, or should I be concerned about this? And more than likely, someone will have answered your question or asked your question before, and there'll be someone there to give you an answer. So if you have any trouble with accounting, it's good to be able to understand the different layers of each financial statement. Of course, it's good to know that there are 4 main financial statements or 3 main ones that people look at. There's the income statement, the balance sheet, and the cash flow statement. And there is one other one, statement of changes in equity, but people don't really look at that one too closely when investing. But it is good to have a basic understanding of accounting. So it's really important, if you don't, that you go out and at least do your due diligence and learn a little bit about accounting. But let's go and have a look at the balance sheet to see what their equity is like. So their equity has been declining for a few years and then rising again, but it is rising overall and at quite a high rate, from 100 to 500, which is a 500% increase over that 10-year period or 12-year period or whatever that is. So that's going to be fine. We'll be moving forward with that. There's no issues there. And then we can have a look at free cash flow. And again, free cash flow has been growing at a very high rate. So those will be all good. Let's enter in those numbers and see what our spreadsheet comes up with. All right, so I've just gone ahead and entered in all of the numbers for stamps. Let's have a look at their growth. Wow. Yeah, so their growth has been incredible, actually. I've never seen numbers like this before. This is probably the best numbers I've ever seen, to be honest with you. And we can see that long term, all of them are 20+%, which is incredibly high rate of return to get over a 9-year period. We've got 35 and 37% growth in EPS and free cash flow, which is incredible. And looking at the graph, we can see that not only are these growth rates incredibly strong, they've been getting stronger over time, or at least they've been stable, which it looks like they've been stable for sales. Yeah, bouncing between 20 and 30%. And equity has been bouncing between 23 and 33%. So pretty stable, which is really, really good. Then, of course, we need to see what kind of return on invested capital they have. So we'll go over to MSM Money, and we'll have a look at that. Wow, that's really impressive as well. So their return on invested capital for the 5-year period has been 18.8%. And their return on invested capital for the last 12 months, has been 30, which is really, really high. So that's really impressive. We need to now check their debt. So we need to find the current assets, current liabilities, and total liabilities for 2017, which we will find on the balance sheet. We've got current assets 271. We've got current liabilities of 115. And we've got total liabilities of 181. Let's fix these. So again, amazing. Wow, this is a crazy good company. I can't believe I haven't looked into this myself before. Current ratio of 2.36, which beats our minimum requirement of having 2 times as much current assets as current liabilities. Their debt to equity ratio is 0.36, which is incredibly low. That's one of the best I've seen. I like to see below 0.5, so that again meets our requirement. And I'm just going to chuck in the last couple of data points that we need, which is the PE ratio. So let's get the PE ratio for stamps.com. Okay, so this is an issue that comes up with a lot of newer stocks where there's been times where their PE ratio has just been ridiculously high, like 420. That is insane. And that's not a number I'm going to use in my calculations because it's just not going to happen again. It's very unlikely to happen again. And we know that it actually occurred because they had very low earnings at this time in 2015, and that caused, because the price didn't move and the earnings were so low, it means that the PE ratio went up massively. So let's have a look at here. So we've got 42 down to about 25. So we could assume that they're going to bounce somewhere between 40 and 25. And I think that's probably a safe bet. And we'll say the average is the current one because I want to use this because look, as you can see, the PE ratio has been shrinking over time, and that's natural as the growth prospects of a company slow down. So it's more realistic to use a conservative number. So I'm going to use that 24%, or 24 PE actually, as our average. So I don't always make this what it really is. It's a bit subjective. I kind of just tweak it. But let's go with a 20, a 25 as the average, and then a high of 40. And that will give us a broad range of outcomes. Actually, we'll make this 30, and then that's nice and neat. So Stamps clearly passes our test, so let's give it a green. And let's quickly have a look at Skechers and Wynn. So having a look at Skechers, they've got strong revenue growth, strong earnings per share growth, so this could be another company that we're interested in. Their equity has been growing very strongly, so I like that. That's what I like to see. Let's have a look at their cash flow, actually. Let's have a look at their free cash flow. Free cash flow has been declining, actually, which is not a great sign. But we can just check to see if they've been operationally profitable. We can look at, oopsie, didn't mean to do that. Let's go into Skechers again and look at their cash flow. Yeah, so as you can see from their cash from operations has been mostly positive, so that's a good sign. Although increasingly they've been spending more in capital expenditure, and that's what they do. It's got two parts, this property, plant, and equipment. The first part is maintaining their current assets, so it's basically what they need to pay to maintain the business, and then the other part is growth. So what are they spending their money on? What investments are they making in order to grow the business? And they've been spending a lot more, so we could have a look into their financial statements and see what this has been spent on, and see if it's a worry or anything like that. But let's go ahead. I'm going to go ahead and assume that this one's great, and I'll chuck the numbers in while off screen because I don't want to waste your time, and I know this video has gone on forever. So we'll just assume that's good, and we'll have a look at Wynn, and I'll briefly go over the numbers in the spreadsheet for Skechers next week. I'll just write it here. Go over numbers in next week's. Yep. All right. So Wynn Resorts, again, it looks like it's going to be one we like. 8.9% long-term revenue growth. Earnings per share growth over 10%. That's enough. Sorry, I'm starting to lose my voice here. I've been talking for so long. Shareholder equity has become negative a couple times, but is starting to grow again. So that's not too bad. We can still have a look at this stock. It's not perfect, but we'll still have a look at it. And free cash flow at sometimes has been very negative and sometimes very positive. So it's a bit all over the place. Not something great to see, but we'll hang on to it and we'll have a look at it next week. But that's all I've really got time for today. This video, I think, is probably going to be about 25 or 30 minutes. So that's probably as long as I want to make these, so that I don't waste your time too much on a Saturday. But if you have any questions, let me know down in the comments section below what you want to see next week. But basically, if all goes to plan, we're just going to go through and start to value these companies and sort of have a bit of a deeper look into different aspects to see if there's something that we don't like, and something that can knock it off. Because basically what I like to do is I like to try really hard to find something I don't like about these companies, and I dig deep until I find it. And if I find something, I don't invest in it because I only invest in companies that are perfect. And that's what we're going to go through, and we're going to break down, and I'll show you how I break down each of these companies further in depth. But if you enjoyed this episode, make sure you leave it a like. It helps me out a ton. And if you're seeing me for the first time and you want to catch these new episodes, make sure you become a subscriber so that you don't miss out. But that is all for today. I hope you guys have a great day, and I'll see you in the next one.